position somewhere over here, and boom, as you can see, again, it would have worked just perfectly. Indicators are an essential part of day trading. It can dramatically improve your trading performance. There is no one best indicator, they all have different purposes and they are used in different ways.
For simplicity, trading indicators are often divided into different categories based on their function. These include oscillators, volatility, support and resistance, trend following, leading, and many more. They are used in different ways by day traders to improve decision making.
Some traders use indicators and some do not. Although price action alone is enough for you to be a profitable trader, indicators are a great tool to improve your trades even more. My name is Lucas, this is Magic Markets, and today I will show you my top 3 indicators picks that you can use to improve your trading. Starting with... So the first indicator that we will discuss today is Bollinger Bands. Bollinger Bands is a simple range indicator that detects potential reversal points. Now this is how it looks like on the chart. First of all, we have the bottom range right here, then we have the top range, and we have the middle ground, which is moving average. Bollinger Bands is a great indicator when you need to identify potential support and resistance levels. The best way to use Bollinger Bands is when the price is consolidating or moving sideways. So you know that we have only 3 different market conditions. One is when the market is going downwards, so a downtrend. Other one is when the market is going upwards, so a upwards moving market or a bullish structure, and then the market can move sideways, so side moving market or consolidation. The best market conditions to use Bollinger Bands is a side moving market. When the price reaches the top range of the Bollinger Bands, that means that the range is indicating that the price will potentially reverse. As you can see, we have this point over here and here and here, and all of these points are touching the top range of the Bollinger Bands. That means that over here we have a strong resistance level. Same thing at the bottom. Here we can see that the price is being rejected from the bottom range, and also over here. That means that we can mark another support level. When you use this information with other tools, you could have potentially found a great entry over here. My second pick is moving average convergence divergence, or in short, MACD indicator. MACD is an indicator used to find the perfect entries. The first thing that you need to understand before using MACD is basically that opposite of Bollinger Bands, this particular indicator should be used in trendy markets like this, when the price is going upwards in a bullish trend or is going downwards. So basically it is a trendy market and it has a clear direction. First of all, the highs and the lows of the price correlates with the highs and the lows of MACD. Here we have the high of the price, and also we have the high on MACD. Then if we move on further, as you can see, this high correlates with this high, then this lower high correlates with this lower high. So basically the price correlates with MACD lines over here. On MACD we have 2 different lines which are crossing, and a cross indicates that here you should open a position and that it is a great entry point. Now if we look at the crosses on MACD, as you can see over here we have a cross. That would be an indication that here we should open a position, and as you can see, this position would have turned out pretty well. And same goes over here. We have another cross right here, which is an indication to open a sell position, and boom, over here, if we would have taken this signal and opened a short position, as you can see, it probably would have worked really great. And the last thing that you need to know about MACD is really important thing, that you cannot take MACD entry signals against the trend. Now if you have an upwards trend, the price is moving upwards, boom, making higher highs and higher lows, that is an indication that you never take signals into the short position. You are only waiting and interested in positions to long the market. And the last indicator for today is a relative strength index, or RSI indicator for short. RSI is a really common indicator and it is used to find momentum of the price, and basically it measures the magnitude of the price movements. Now this is how RSI looks like. It's pretty simple to understand. You only need to know two lines right here, the bottom line and the top line. So when the price is above the top line, as over here, that means that it is an indication to short the market. And when the price is at the low point over here, basically this line is below the bottom momentum line. That is an indication that you should open a buy position. Over here we have a momentum of the price going upwards, and on the RSI we can see that this line has crossed the top momentum line, and that is an indication that over here we should open a short position. Later on we can see that the price line over here crossed the bottom momentum line, which is an indication that we should open a buy position somewhere over here, and boom, as you can see, again it would have worked just perfectly. Now the most important rules when using indicators is that you cannot use indicators alone. Here I showed you the examples of how you can open buy positions, open sell positions with indicators, but they are usually not always right. That means that you should combine them with different tools to get the best entry points. Remember, never use indicators alone. Now, indicators provide you with a lot of additional information, but you have to remember that they have their drawbacks as well, which you need to know. Now, really important drawback of indicators that you should understand is that they do not take into account fundamental news and also technicals. That means that indicators basically show you their signals based on historical data, and that means that they cannot predict the future because they cannot take into account different complex things that are happening and that are moving the market. If we take Bollinger Bands as an example here, but basically it applies to all indicators. As you can see over here, we are at the top range of the price. That means that the price will soon reverse, and if we open a position, as you can see over here, we would have been right and we would have made money. But on the other hand, if we zoom in a little bit over here, you can see that the price is touching the bottom range, which is an indication to open a buy position. But if you do, as you can see over here, you would have been stopped out and lost money. And that's the drawback of the indicators. They are not always right because they cannot take into account everything. When you combine indicators with other tools and you use them properly, that's when you get the best probabilities for your entry succeeding. One indicator, which is also a great indicator that I have left out of this video, is moving averages, because I have made a separate whole video about them, how to use them, what they are, and how you can apply them to your own trading. So if you're interested in that, consider watching that. And the last indicator that I wanted to show you, but I left it out, is moving averages. Moving averages is a powerful indicator, but I have dedicated whole another video just to explain how powerful and how you can use it. So if you're interested in that, consider watching that video. Hopefully you found this video valuable and informative. I am doing these on weekly basis, so if you're interested in learning more about trading, about advanced concepts, advanced strategies, consider subscribing and leaving the like on this episode.